In 2008, real estate went into an extreme bubble, and the stock market had gone down, but it went back up into not a super bubble, but just a bubble. And when real estate crashed, it pulled the stock market down with it. And this time we have the almost everything bubble. So yes, these charts, I think it all points to the greatest economic disaster in history, because the higher the cliff, the bigger the fall. And we are on the highest cliff that has ever been experienced by mankind. JP Morgan said it best, gold is money, everything else is credit. Hello and welcome to this video. I've got Ronnie Stofferle again with me. Ronnie, how are you doing?
Hi, Mike. Good to see you. All good. How are you, my friend?
Good. So you just returned from the Dubai Precious Metals Conference and you gave a presentation entitled Showdown. And I think we're going to run through a little bit of this here. So I've got that on my screen. And I do like this, the world's greatest showdowns, and James Bond and Goldfinger. That's great. So you've got this split into three parts. And I haven't seen this before. You're going to be showing a lot of these charts to me for the first time. So the first section is monetary policy. Tell us what you've got here. I noticed you've got all of the rate hikes numbered here, don't you? And there's only 3 outliers. Is that what you're showing? Every time there's a rate hike, it ends up in recession, except for 3 times in this chart, right?
Exactly. So actually, the thing is, the Federal Reserve is kind of playing a game of chicken, and now they have to choose between fighting inflation, financial stability. So if they choose the tight road, financial markets will probably revolt at some point, and the carnage in bond and equity markets will continue. On the other hand, if they choose financial stability over fighting inflation, I think the Fed will kind of will risk losing the credibility that they have painstakingly rebuilt over the last couple of months. So on this chart, we're basically seeing that, well, since 1915, every major rate hike campaign actually ended in a recession, and there were only 3 exemptions to the rule, 3 out of 20. So right. From my point of view, given the enormous amount of sensitivity to rising interest rates, there is actually no doubt, Mike, that we will move into a recession, probably rather sooner than later. And we all know what the Federal Reserve is doing when the bad R word actually becomes mainstream. So this is basically telling us, well, actually, the market are already kind of pricing in the first rate cuts. And I think if we talk in a couple of months, probably interest rates will already be significantly lower than they are at the moment.
Yeah, I agree. I think but the Fed is always reactionary. Something happens and then they react to it. It's like Elon Musk said, they're driving by looking in the rearview mirror instead of out the windshield. And he added to that, they're watching a replay of a video in the rearview mirror. So they're looking at trailing indicators instead of what could be happening in the economy in the future. They're looking at what just happened in the past. So we've got these 3 outliers, but there's several factors that have to line up for them to officially call it a recession. I had a different business back in 1993 and 4, where that third red circle is, and I know we had the first Gulf War, and we had a bunch of other things, and the economy was not like overheating or good then. The rate hike cycle went up, but we were basically still semi-recessionary. Like they haven't declared a recession already, but I've noticed here a big slowdown in restaurants, especially like midweek stuff. There does seem to be something else going on. But let's take a look at your next chart. Leading economic index has successfully predicted every recession. So tell us about this index and what you see.
Yeah, I mean, Mike, we know Dave Rosenberg, I think, said that every recession starts out looking like a soft landing. And now, we're kind of in this Goldilocks scenario. Soft landing is kind of the consensus view. However, and as you've rightly said, I think as good analysts and investors, we should not look through the rear view mirror, instead always look through the front window. And this is exactly what this indicator does. This is a leading economic indicator. It's actually an indicator that is comprised of 10 different sub-indicators. And I really like this indicator because it has pretty good track record, actually. So since 1965, the leading economic index has successfully predicted every recession. And now the index is already declined.
If you drew a line there at that 5% mark or a little bit higher, then it is 100% reliable. Once it pierces, like once it goes more than 2% negative or 2.5%, it has nailed it every time, hasn't it? I mean, there's a couple of times where it touches 0 and doesn't trigger a recession. But yes, you are right.
And I think we are now like declining for like 18 months in a row, which is, I think, the third longest decline in the last 70 or 75 years. So actually, I think this is screaming recession. And
yes,
I think, Mike, we shouldn't forget that we're moving into an election year in 2024. So obviously, the Democrats don't want to hear the bad R word, while on the other hand, Republicans will try everything to make the U.S. economy look weaker. So I think we shouldn't forget about the political aspect next year. But the pure facts based on this indicator are clearly telling us a recession is on the horizon.
Yeah, if you jump off the top of a building and you're falling, you can be saying, so far, so good, all the way down. Is that last 1/1000th of an inch that hurts. So a soft landing always turns into a very hard landing. Ask Humpty Dumpty. So what have we got here? Negative bank credit growth. This is very, very important. Bank credit growth is, we're on this phony monetary system, and most people don't realize that the stuff in their bank account isn't dollars that the Fed created. Those are dollars that the banks created, and it's actually not dollars, it's bank credit. It's denominated in dollars, but the bank just creates a credit when you have an asset that they can monetize. You bring a house into a bank, say, I want to buy that house, I want to borrow $1 million, and they create a credit. Okay, we'll create a credit for $1 million and deposit that credit into your account. It's all bank credit. JP Morgan said it best. Gold is money, everything else is credit.
Yeah, so I think we talked about this chart in our last session already. I think it's a fantastic chart because, as you know, credit is the lifeblood of modern economies, and here we are seeing really that the credit conditions are deteriorating dramatically. So usually, every time just the momentum of credit growth weakens, we're moving into recession. But now it's even a magnitude worse because we're in negative territory. So we're actually seeing contracting credit. So, and
there's only one other time that it was negative, and that was after the 2008 global financial crisis. Every time it goes below 4%. Is or 5. That is, I mean, look at the double dip recession of the 80s, the Ronald Reagan recessions, and you're talking about this reversal occurring at plus 6%, and here we are negative suggesting that this hard landing is going to be harder than anything. I mean, this is going to be the biggest thing since, but I believe it'll be bigger than the global financial crisis of 2008. What's your opinion on that?
Well, I can only tell you, Mike, that large parts of Europe are already in a recession. Actually, we're really seeing anemic growth. So an economy without any momentum, without any power. It's really frustrating to follow what's going on in Europe. And actually, this in combination with pretty sticky inflation rates that puts us into a stagflationary environment that for some reason nobody really wants to talk about. Then on the other hand, China is not doing so well as we all know, although they really try to start stimulating big time now. And then for the US, I mean, if you inject such an enormous amount of fiscal stimulus in an environment where we're actually seeing full employment, I think the US is running now an 8% budget deficit. Of course, I mean, that's like drinking 8 cups of coffee, 5 Red Bull, and probably also taking a line of cocaine. So of course there's an effect on the economy,
right,
but that's not a very sustainable fiscal policy. So I think we're still seeing this lag effect of this fiscal stimulus sugar rush, but it is kind of fading out over the next couple of months, and therefore I think that the Republicans will try everything to avoid more fiscal stimulus next year due to the election. So this is probably the main case for my recession call next year. But Mike, let's face it, a recession within an economic cycle isn't something that's unusual. Yeah, I think a recession also has lots of positive aspects. Yeah, if you're well financed, if you're running a solid business, actually a recession can be an opportunity for you. You can pick up really good assets, at cheaper prices. Perhaps
in every crisis there is an opportunity.
Exactly. So I mean, I don't really fear the recession, but I think it's no coincidence that over here in Europe, for example, there's quite a large number of really big real estate developers going bankrupt at the moment, and this is clearly a sign that actually they can feel this enormous move on the rate side, because we all know that those real estate developers were highly levered. And if you're running on a variable interest rates, of course that can break your neck.
I was in Utah for Thanksgiving with some of my family, and I did a video for Thanksgiving, and it was all about the scale of the bubbles that were on and the 3 legs of the economy. And the real estate is in the most massive bubble it's ever been in the United States. But then the stock market is, just coming down from it 2 years ago peaked, and so it's in a massive bubble, and it doesn't matter how you look at it, whether you look at PE ratios or the Buffett indicator or the number of hours of the median wage in the United States that it takes to buy 1 share of the S&P 500. It's in an historic bubble. It's something that has never been seen before in history. And then you take the end of the 40-year bond bull market. Bonds are also in a bubble. In the year 2000, bonds and real estate weren't touched when the stock market crashed because they weren't in their extreme ends of a bubble. And then in 2008, real estate went into an extreme bubble, and the stock market had gone down, but it went back up into not a super bubble, but just a bubble. And when real estate crashed, it pulled the stock market down with it. And this time we have the almost everything bubble. And so, yes, these charts, I think it all points to the greatest economic disaster in history, because the higher the cliff, the bigger the fall. And we are on the highest cliff that has ever been experienced by mankind. And so this is your analysis of the this first portion of your presentation. So what have you got here?
Yeah, so Mike, I think we're both not in the soft landing camp, obviously.
Right.
But I think, we have to be pragmatic and make the best out of every situation. So in our last In Gold We Trust report, we introduced the incrementum recession phase model, where we said that every recession has 5 distinct phases with different characteristics. And then we crunched the numbers and calculated what actually works best over the course of a recession. And gold is, as you can see on the table, is an excellent recession hedge. On average, it was up 10.6% throughout the recession. Then silver, equities, and commodities have in general a negative performance during a recession. But, and this is important, in phase 4 and phase 5, this is the phase when, I would say that central bankers and politicians really hit the panic button. And when this aggressive reflation actually starts, because as we know, recessions are most of the time only officially announced once the worst is already over. So in phase 4 and phase 5, it makes sense to become more aggressive, because then silver, equities, but also later on commodities do perform better. But I think what was really interesting is that except for phase 3, on average, mining stocks show a pretty positive performance on average. So therefore, over the course of a recession, gold and mining stocks are doing a pretty good job. And in the later stages of a recession, you can also get more and more aggressive on silver, on equities in general, and to some degree also on commodities. But I think it just shows us, if a recession is coming, then gold should be a pretty reliable hedge.
That's one thing I've always told people, is that your core position should be the physical precious metals itself, that has no counterparty risk and no danger of a mine collapse or an environmental protection agency shutdown or a strike or bad management or any of the other risks. And then there are times when you get this wonderful upside leverage out of the mining stocks. But to do that, you need guidance from somebody like your company. You don't want to be just blindly investing in mining stocks without somebody really doing in-depth analysis on the mining stocks. When you analyze like the Barron's Gold Mining Index from the day that gold became free trading, August 15th of 1971, to today, the physical metal has outperformed the Barron's Gold Mining Index by like a factor of 8 times, 800% and greater gains than because you've got leverage on the way up. You might have gold might go up $1 and the mining stocks go up $3, but you've also got leverage on the way down. And then whenever it's noodling sideways, the stocks tend to lose a little. So you need guidance. I want to tell all our viewers, you need guidance from somebody like Ronnie's company in this, if you're going to. So I have the core position, and then there's my gambling currency that I use on the stocks to gain leverage. So yes. Okay.
I can tell you, Mike, since I started analyzing and investing in mining stocks, I've lost lots of hair, as you can see.
Yes.
It's a tough business. It's probably really not a long only investment. You have to actively time the mining stocks, because there is so much that can go wrong. You've got geological risk. You've got management risk, and you're seeing one of the worst management teams in the mining space, unfortunately. You've got political risks, expropriation, new taxes, and so on. You've got financial risk, costs of capital are very high at the moment. Then you've got the gold price risk, yeah.
Right.
So actually it's a tough business, but it can also be very, very rewarding. And the last couple of days in the mining space were actually great fun. But I completely agree. It is really an asset class where you have to do your homework, or otherwise just trust investment professionals.
Okay. I want to thank you so much for running us through this. And I think we're going to come back in future videos with more on this same presentation. So thank you very much, Ronnie.
Thank you, Mike. Always a pleasure.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 1-1-1. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.